It's a video on financial options, specifically calls and puts. It's brought to you by PolarisInvesting.com, a site for creating defensible valuations. As a reminder, business valuation is based on expectations derived from the skillful consideration of past facts and future possibilities. In this discussion on options, first of all, we're going to be deriving the Black and Scholes option pricing formula to make sure we all have a solid foundation in the theory behind the formula. Then we'll be talking about the formula as it applies to stocks, but also as it applies to valuing businesses and even projects within a business, so other financial instruments besides just strictly stocks. Then we're going to finish up talking about different combinations of calls and puts, namely collars, straddles, strangles, and spreads. All right, so now we're going to start talking about the derivation of specifically of a call option, or the option pricing theorem for a call option created by Black and Scholes. And as a reminder, off to the right here, showing the payoff diagram for a call option. And this is showing, for example, you have a call that costs $1 and a strike price of $25. So it shows up to the point of the stock going from $20 to $25. The investor's out $1. But once it starts going above, stock price starts going above $25 a share, and namely when it gets up to 26, which is exactly $1 above the strike price, it offsets the cost, and therefore you're breaking even, and anything after that, you can see here that the payoff for a call option increases. This is typically stated as purchaser of a call option has the right, but not the obligation, to buy the underlying stock at a predetermined strike price, which in this case is $25, by the expiration, or on the expiration date, if you're talking about a European style option. Now, American options allow you, the owner of the option, to exercise their right to buy the stock at any time before expiration, but we're going to be sticking to European options during the derivation of the Black and Scholes option pricing theorem, and then we'll discuss how American options are accounted for. Mathematically, this payout diagram is represented by the maximum of 0 or the stock price at expiration, also known as time t, minus the strike price, also known as exercise price. It can be shown that that maximum will always be greater than or equal to the stock price minus the exercise price. The reason it's always going to be, this maximum is always going to be greater, is that the stock price could be less than the exercise price at expiration. If that's the case, then over here to the left, this becomes negative, but because we're using the maximum call option, an investor, if it is negative, if the stock price doesn't equal to or become greater than the exercise price, well, let's choose not to exercise their option, and therefore it'll just expire worthless or 0. Another way to think about this relationship here is that you can say that the stock price at time t in the future is what the payout is, and then the investor will need to pay back, and we'll see here what's assumed to be borrowed as part of the initial cost, but we'll need to pay back the future value, which will be the exercise price. And you can see that this is true if we assume that the stock is greater than the exercise price. And you can see the relationship holds, it's equal. Now, like I said, if its stock price is less than E, then it's out of the money, and this left side of the equation would actually be negative. Now, with that being the payout, let's look at what the cost would have to be at time 0. Well, it would be the cost would be the purchasing of the stock, which gives you the possibility of a higher price at time t, namely S of t. But you initially start off by buying the stock, and then the total out of pocket is less than that because it's assuming you're borrowing the exercise price divided by the time value of money. So you can see here when you go into the future, this becomes just E. So you are paying back the strike price E at time t after borrowing the present value of E at time 0. And then this maximum on the right side of the equation, you substitute for S of t, you're now talking about time 0, S of 0, and E is now the present value of what was borrowed, namely E divided by 1 plus R of t. Now, just like in the case in the future here initially, if the stock price is above the exercise price, these will be equal. But if the stock price is below the exercise price, which is typically the case when you initially buy an option, this left side will actually be less because the investor will choose not to exercise the option right at the get-go because it'll be negative, so it'll just be 0 here to the right. Now by moving this expression or adding it to both sides of the equation, you end up with this equation here, which is the replicating portfolio that Black and Scholes came up with, saying that the value of a stock today is one portfolio you could have, but you could also have a portfolio that consists of this option plus this amount here, the present value of the exercise price. Now, in reality, the actual price of the option, which is shown here as the maximum, is actually represented as just the call, and it's going to be a little bit more than the actual maximum because the maximum is just binary. It is either going to be the difference between the stock price minus the strike price or 0. The reality that there is two components of any option. One component is the intrinsic value, which is simply above the strike. How far above the strike price are you? But there's another component of it called the time value, and that's why this presentation was even started out with this diagram to show that before you hit the expiration date, you have the possibility for the stock to either go up or down, and that possibility or variability into the future adds value to the stock, to the option. So you're actually going to always end up until expiration date that this right side of this equation will be larger than the left side. Now you can see at expiration they'll be exactly the same, but previous to expiration, the call option value, time value of the call option will cause the equation such that the right side is larger than the left side. Now, what we're going to talk about next is how an investor could attempt to hedge here by buying some shares and selling a call, such that they could achieve a riskless arbitrage by buying so many shares if the call option was mispriced. But the main premise behind the Black and Scholes option pricing theorem is that it's set up a dynamic hedge that eliminates riskless arbitrage opportunity. And then at that point, the call option is considered to be correctly priced. So let's go through the derivation of a properly priced call option. Well, to do that, you think about here at time 0 that you have a stock that's worth, let's call it S0. And for a single period, meaning one period later from now, whether that be a month, whatever time period we're looking at, but we'll just call it generically one period forward, the stock can either go up in value or it can either go down in value. And let this be a percent. Let's say if it goes up by 20%, that would be 1.2. Or if it dropped by 15%, that would be 0.85 times the initial stock price, or 1.20 times the initial stock price. If the stock price ends up going up at time t, then the value of the call increases to CU, and the value of the position taken at time 0 is now worth H times the new increased stock price minus CU. If the stock price goes down at time t, then the value of the call decreases to CD, and the value of the position taken at time 0 is now H times the stock price down minus the price of the call CD. Well, not knowing for sure whether it's going to go, stock will go up or down, how do we as an investor set up a hedge so that we're indifferent? We only make the risk-free rate of return, regardless if it goes up or down. Well, you do that by selling a call but buying H shares of stock. So your initial cost is whatever H number of shares that you end up initially buying, and then you subtract off the cost of the call that you would receive by selling the call. So now at the end of the period, the value is either going to be the H number of shares you bought times the price of the stock after it went up minus the increased value of the call, namely CU. Or it's going to be the H number of shares times the down stock price minus the decreased cost of the call, namely CD. So in order to hedge such that investors indifferent as to whether it goes up or down, you first of all have to find out what is the hedge amount, how many shares of stock. Well, the way you do that is you just set these two values equal to each other, equations equal to each other, and you solve for H. When you do that, you get this expression for H over here. Then you set that expression equal to an alternate derivation of H shown here below. And where this expression of H came from is you assumed that your initial purchase here of H shares of stock at time 0 minus whatever the proper value of the call option is, or correct value, at most is going to earn you a riskless rate of return of RF. So when you solve for H in this formula, you get H equals what's shown here. But notice here that you end up with C0 in the formula. And that's exactly what you're interested in knowing. What is the actual correct value to charge for the call? Well, now that you've got two expressions for H, you set them equal to each other, and then you solve for this underlying, or this C of none. That's shown down here. When you get done doing the math, you get what looks like a fairly involved equation, but it simplifies, because what if you notice here is that this part of the expression here plus this part of the expression, when added together, results in them having a common denominator. And you get U minus D divided by U minus D, which is 1. So that means the two terms are actually complements to each other. The larger this is, the smaller this is, and the combination of them can't be above 1. So you can essentially think of that as a probability, P. So you get some probability that the stock is going to go up plus 1 minus P, that it's going to go down, and then you divide it by R, which by the way is defined to be 1 plus RF. This gives you the present value of the expected value. Now let's go look at a one-period hedge example and see how it plays out. So we show the different formulas that all have to end up being equal to each other. Namely, if the stock goes up, you get this formula. If the stock goes down, you end up with this formula. And then, but you're looking for whatever the initial cost is, and namely C of naught is the true cost of the option. You're only going to earn a risk. You don't want to have an investor have the ability to hedge in such a way that they can earn anything in excess of the risk-free rate of return. So all those must turn out to be equal. And then if we just do the math here to figure out what H is, and we assume some values down here for the beginning stock price, the exercise price, and then how much we expect it to go up or down in that period, and what the risk-free rate is, and therefore what 1 plus RF is. You can calculate what H is. You can see here when you do the math, you get an H of 0.2, which means you're going to purchase 0.2 shares of stock to go along with selling a call. Well, let's verify that this hedge of 0.2 does result in a riskless rate of return being earned. If the investor were to attempt to do this, they would earn nothing but a riskless rate of return, assuming that because the cost of the call was derived correctly in order to remove any kind of riskless arbitrage opportunity. So if we look at this formula here and assume the stock had gone up, we look at the hedge ratio and then what the equation works out to be, and it works out to be 17. But if the stock had gone down, it would have worked out to be 17. And then you can see here that that's equivalent to the risk-free rate return times the initial cost minus what we figured out the value of the call option to be here, and it's 17. So we have removed through this one period example the ability, by hedging correctly and having the correct value determined for the call option, remove any opportunity to do a riskless arbitrage. Now, if you extend this to 2 periods without going through all the details, you essentially end up with a value for the call option that is similar in format to what we got in the 1 period model, but you introduce a few additional terms, but you keep the concept of P and 1 minus P, and what you'll notice here is you end up with a binomial a binomial formula when n equals 2. So if you keep extending the number of periods, you end up with this general expression for the cost, the correct cost of an option over n periods. Now, if we take this equation here and rewrite it, noticing or realizing that this up and down sequence that occurs as you're summing up all the different combinations can be rewritten as the maximum of all the ups and downs for a particular n and k, and minus the e divided by 1 plus rf to the t. And now we rewrite this equation, and you get the first part here minus e over r to the n with the same expression for the binomial formula. Now, important to notice that unlike in the general form, or before we rewrote it, we went from k equals 0 to n for the n number of periods, but there's going to be certain combinations of k, or there's going to be k's such that the combination of up and down results in a stock price below the strike price. So we're just going to ignore cases where this maximum of whatever uk and n minus k is that equals 0, and we're just going to assume that that's some m greater than n over 2 is where we start summing up from in order to get rid of anything that equals 0. Now, if you let this number of periods approach infinity, the length of any one period becomes much smaller. So if t is the total time span, and you're breaking that up into multiple periods, again, as you get more and more periods, each period gets smaller and smaller. This results in a distribution called the Poisson Distribution, where the standard deviation becomes equal to the mean, and then this term lambda is used, and you end up with this plot of a line represented by this mathematical formula. And we can see here that when the lambda becomes 10, or the mean becomes around 10, you get here in the blue something that looks very similar to this red curve over here to the right, which is representing the normal distribution. So I want to point out that both the normal distribution and the Poisson distribution have similarly formatted formulas, namely you have some coefficient times e to some negative exponent, but the coefficients, as you can see, are quite different, and the exponents are much different. Even though the curves with a lambda being above 10 or more is similar to this red curve over here in the normal, and red represents a mean of 0 and a standard deviation of 1. Now up to now we've conceptually shown the derivation of the Black and Scholes option pricing formula through the use of the binomial formula, and now shown that as n approaches infinity it becomes the Poisson distribution. But the Black and Scholes formula uses the normal distribution because its table is more widely available than the Poisson distribution table, so the conceptual view of it doesn't quite match up with the actual implementation of it. So when you look at the values that are used in the Black and Scholes formula, namely the cumulative normal distribution with a parameter of D1 and a normal distribution here of parameter of D2, they don't smoothly translate to what we've been talking in terms of this conceptual view. Now another way to look at that is here in the normal distribution. You probably remember from probability and stats that you would have a table that you would look up probability. Here you can see that if you go all the way to 3.9, you get a probability of 1. It just means everything to the left of that point is essentially the total area under the curve. And there is a way down here, if you can make it out at the very bottom of the screen, it shows you how you would take other values besides mean of 0 and a standard deviation 1, and you can scale, or what is known as normalize it, to whatever mean and standard deviation you have. Normalization allows you to use the table and calculate cumulative normally distributed probabilities. So the Black and Scholes formula is based on the use of this table and function, so that we have to be aware that even though conceptually we've presented it as the binomial now up to the Poisson when you let n go to infinity, but the actual formula itself is based on the normal distribution. Now, in summary, the Poisson distribution is described to be like the normal distribution, but it's not the same. It's really best to think of how the cost of the call option changes as n increases from 2 to 4 to 8 to 6 all the way up to infinity. And that's shown in this picture here, that when you take different n, you can see that when n is 2 versus the continuous time formula, there's a fair amount of discrepancy between the two. But when you take it all the way up to n is 12 periods, you can see already that they're almost on top of each other. So just intuitively you can see that the relationship between these formulas do align. Now if you're interested in a more detailed mathematical explanation, you will need to know how to do partial differentiation and how that differentiation applies to stochastic processes. And there's a lot of the proofs out there of this exact relationship involves what's called Ito's lemma, which is essentially a chain rule for differentiation applied to stochastic processes. That math is very involved, and like I just showed, that level of detail can actually be sidestepped, because we can just show that here that using the discrete case of the binomial, that when n gets to just be up to 12, you can already start to see that it's similar to the complex continuous case, which the Black and Scholes formula uses. Now the formula that Black and Scholes came up with also makes some intuitive sense, because you relate it back to the binomial formula, you do see the current value of the stock is shown here, and because it is the current value, there's no it's already in the present value, so you end up with this to multiply it by the normal distribution, which turns out to be the present value of the expected stock price at expiration. That only includes combinations of future stock prices that are above strike price. Normal D1 by itself is referred to as delta, and it's discussed further in the section on Greek indicators. This other expression is E, which you can see up here in the binomial formula, but it's now taken to the present value because E is a future value exercise price. So now you take it to the present value, then multiply it by a normal distribution. And this normal distribution relates to the probability of in-the-money option at expiration, meaning the stock price is greater than the strike price. Now the D1 and D2 are, like I said, we're beyond what we're going to try to get into, but here are the expressions, but they're related to each other. You can see here that D1 is this value, then D2, it just subtracts that off. So they are very similar in their form. The formula is in the form of S naught minus the present value of E that was discussed at the beginning of the formula derivation discussion. By the way, I should point out that this is for European call options that assume that you can only exercise at the expiration date. Also assumes there are no dividends, and another assumption is returns are normally distributed. And finally, assumption that volatility or the variance is constant throughout the life of the option, namely time t. Now there are several straightforward ways to account for dividends in the formula by noting a call option owner foregoes dividends. One common way to do that is you introduce e to the minus delta t, where this delta is the continuous dividend yield. Recall that in theory a stock price drops when a dividend is paid. Thus it can be advantageous to exercise a call option just before the ex-dividend date. The e to the minus delta t in the option pricing formula is a factor that accounts for future dividends by assuming dividends are paid continuously. But in reality, dividends are paid discretely at the end of each period. Right after each ex-dividend date, the factor correctly accounts for all remaining dividends. But since the factor assumes dividends are paid out continuously, the factor gradually excludes portions of the upcoming dividend, causing the call to be increasingly overpriced leading up to the ex-dividend date. Now, many factors go into determining the value of a call, and dividends are relatively a minor consideration. Thus, using an approximation for dividends doesn't impact the call value that much, particularly when there are numerous dividends over many years. Now, other things about American options you should be aware of is that, like has been shown earlier, that there is value in the option, in the call option, to keep it alive as opposed to exercising it. The more time remaining before expiration, the more possible future stock price variability, which increases the option value. And this is definitely true for call options without dividends. And it's even fairly true with this approximation for dividends. Dividends actually, relative to all the other variables that go into making up a call price, really are a small portion of that. So the approximation for dividends even makes that true for American style options. So it's always best to keep the option alive as opposed to exercising the option when there's still life left on the option. Now that's not true for put options. There's a case when you have a fairly small stock price and you're in the extreme case of in the money put option, that there could be an advantage to exercising the put option, American put option, before the expiration date. But that's a fairly unique situation, and most times it's true that even for American put options, it's best to keep them alive as opposed to executing the option. Okay, to finish up the discussion here on the background of the Black and Scholes option pricing theorem, I want to go over this equivalent expression for it and use it to summarize what we've concluded about the Black and Scholes option pricing theorem. Then here it shows that a call is equal to the current stock price times the cumulative normal distribution with the input variable of D1 minus the strike price X discounted back to the present time using a continuous compounding times the normal distribution with the input factor of D2. Now, unlike the strike price X, which is at the end of the T period, S0 is at the beginning of the period and can be thought of as the present value of ST. The strike price is discounted back to the current time using the factor e to the minus RT. Now, to incorporate dividends, if you wanted to approximate the impact of dividends, it shows here that you would add in include the term e to the minus QT, where Q is the instantaneous or continuous dividend yield. Previously that was referred to as delta, but in this summary we use the expression Q. Now D1 and D2 are shown in slightly different forms, but shown here to show clearly that the similarity between the expressions for D1 and D2. They only differ by here at the end as to whether you're adding or subtracting the standard deviation times the square root of t divided by 2. The reason the last term in D2 is negative has to do with the derivative of e to the minus RT. Now make sure you point out that that you want to include, if you're going to include dividends, you also have to include the dividend continuous dividend rate here in the D1 and D2 factors. Summary also shows something we haven't talked about up till now, and that is this concept of the put-call parity. And it shows that a put can be expressed in terms of a call, and then if you are including dividends, you would also have the current stock price times the present value of factor of using the continuous dividend yield rate, and then the strike price and its present value. Well, let's go through why that intuitively makes sense. And if you look over, as we scroll down here so you can see it better, but here at the bottom showing the same thing, put call parity. Here it shows that it does a little arithmetic compared to what we showed over here, added stock price over to on both sides, and so we get here a stock price plus a put equals a call plus the present value of the exercise price. Well, you can see that that's true because the stock, this payout diagram over here shows that if you buy a put, which is essentially an insurance policy, if the price drops below the exercise price, you will still get the exercise price. So you see here that it levels out some value. But because you're also owning the stock, if the stock were to go up, you would get an increase. Now this looks different than just that looks kind of like a call option, but remember a call option would be, if the level part would be negative, it would be the cost of the call, and then as you're in the money it would go up. But because we're adding stock plus a put, it's actually positive. The whole curve is positive. Well, let's see why that's equivalent to a call. Again, a call would be negative, and then so it would look like the same curve, but it would start off negative. But because you're adding now the present value of the strike price, it bumps it up positive for the entire curve and equals to what's on the left side. So this provides you a way to calculate a put based on a value of a call. Or you can do the arithmetic and you can have a call expressed in terms of a put. But there's another way you can calculate a put directly by using the Black and Scholes formula like you did for the call. But the changes slightly in that you put a minus sign in front of the first term and then make the second term plus, and then in the D1 and D2 terms are both negative. All right, so what you end up with here using the Black and Scholes option pricing theorem is essentially 6 inputs. The underlying asset price S0, the strike price X, time to expiration expressed as a fraction of a year, which is T, stock volatility, sigma, the risk-free rate R. Now note this is different from R equaling 1 plus RF, which is used in the binomial formula. This R is the continuous compound risk-free rate and is equal to log of 1 plus RF, which is approximately equal to just the risk-free rate RF. Finally, you have the continuous compound dividend yield. Now the last line on this page is the link to a site that has the Black and Scholes option pricing theorem presented, and it just allows you to enter the values. And the advantage of this site is that it also, if you enter a ticker symbol, it'll automatically pull in a lot of the information that you would need to calculate both a call and a put. And the other thing it does is it calculates a thing called implied volatility, meaning that you enter in a quoted price for a put or a call, and it'll come back with what's the implied volatility. And as we've been talking about in the derivation of the option pricing theorem, the volatility factor is pretty critical, and because it is based on typically historical data, and here you are trying to price something that's going to happen in the future, very important to understand what the market collectively is thinking about volatility compared to maybe what you've calculated or determined looking at historical prices. Last thing I wanted to mention about before we leave the discussion on the theory of the option pricing theorem is this idea of a hedge ratio. To be clear, hedging will only result in a risk-free arbitrage opportunity if the investor is correct in believing the current call price is mispriced. A major tenet of the option pricing theorem is that it's eliminated by virtue of the price that it comes up with for the call. It has eliminated a riskless arbitrage between any kind of hedging, whether the stock goes up, or underlying stock goes up or down. But if the price of the option is believed to be mispriced, then this hedge ratio or hedging number that we're talking about here can result in riskless arbitrage profit. Hedge ratio is actually this the opposite of the value for the first cumulative normal distribution calculation in the Black and Scholes option pricing theorem. Now it's shown as negative because if you buy a call, then you're selling a stock. So the negative just means whatever you're doing, buying or selling the call, you're doing the opposite with the stock. So here, let's say that cumulative normal distribution will always be between 0 and 1. Let's say it works out to be 0.7, so it is minus 0.7. So if you're buying the call, you're selling so many shares of stocks. Now, since contracts for options are written in groups of 100, let's say it is 0.7, that means you would multiply it by 100, and then you end up buying 70 or selling 70 shares of stock short. If you were to sell a call and you want to hedge your position, then you would buy, in this example, 70 shares of stock. Now, the reason this works is that and we'll be talking about this more briefly, or coming up here briefly, when we're talking about the different Greek symbols or indicators used in the discussion of options. But it works because when you take the first partial derivative of the value or the formula for the call option, if you take the partial derivative relative to the underlying stock price, the second half of this formula doesn't have an S is not value in it, so it doesn't factor into the partial differentiation. So the derivative, the first derivative, partial derivative of the underlying stock is just the normal, this first cumulative normal expression. So what it's saying, like any derivative, it's the slope or the rate of change. So it's saying the rate of change of the call relative to the change in the stock price is equal to this cumulative normal distribution using the D1 input values. Now it's easy to get lost in the math and lose sight that the Black and Scholes option pricing formula is really a triumph of economics. It's pragmatically useful despite its complex mathematics. The formula calculates the price of hedging, or which is zero risk, but hedging 8 shares of stock for a specific amount of time. Like any financial instrument, the cost of the option is the present value of expected future payouts. Hedging with a different amount of shares besides H, including 0 shares, increases the risk of the investment. This insight has been used by the financial industry to extend the option pricing formula to all sorts of underlying financial assets. We will explore several alternative uses later in this video. Okay, next let's talk about these Greek indicators, Greek symbols indicators that are used relative to the Black and Scholes option pricing theorem. The Greek symbols that are associated, most widely associated with options, really are the 5 here shown, namely delta, gamma, Vega, Theta, and rho. And what's common amongst all these 5 is that they really are nothing more than partial derivatives of the call or the put option. So for example here the delta is this really the partial derivative of the value of the call relative to the underlying stock price. The Vega is the partial derivative of the value of the call option relative to the standard deviation. Theta is the partial differentiation of the value of the call option relative to the time to expiration. And then rho is the partial differentiation of the value of the call option relative to the risk-free rate of return, or 1 log normal of 1 plus RF. Well, let's go back through these and talk more about what they really mean. Well, the most common Greek symbol used in the option world is delta, and just like its derivative implies, it's the rate of change of the option value, here the call or the put, with respect to the underlying stock price. And so when you take that partial derivative, you can see that you end up with this equation here for a call and this equation here for a put. Delta is also referred to as directional risk. If it is positive, the price of the call increases and decreases along with the stock price. If it is negative, the price of the call moves in the opposite direction of the stock price. A related Greek symbol or indicator is gamma. It is the second derivative of the change of the option value relative to the change in the stock price. So if you remember your calculus class, the second derivative is really about acceleration. So this gives you an idea of how quickly the value of the call option is changing relative to the stock price. You can see the formula is the same for both calls and puts relative to gamma. Next is Vega, and it's probably the second most common indicator to look at. It gives you an idea of how quickly the option value changes relative to the volatility of the underlying stock. Theta, like we already mentioned, is same thing, but now deals with time. Or think of it as time decay. It gives you an idea of how quickly the option value is losing value. And you would expect as the expiration date of the option is approached that the decay would be greater, because as you take steps close, as you're close to the expiration date, As you move even closer, that's a large percentage of the remaining time. Therefore, you're making fairly significant moves in terms of the value. Whereas if you're at the very beginning of the option, you have lots of time before it expires. A 1 or 2 day move closer to the expiration date is relatively small relative to the overall time still left before expiration. And then the last one, as we already mentioned, is rho. It has to do with sensitivity to interest rate change, risk-free interest rate changes. But since that doesn't change that drastically, it's not used that often. So delta is the most widely used, followed by probably theta, and then Vega. Well, now that we've gone through the background of the Black and Scholes option pricing theorem, talked a little about some of the Greek indicators that are typically used associated with the formula. Let's now talk about just the using of the formula. And start off with the two most classic uses of the options pricing formula is to price a call option or to price a put option. So up here on the top of the screen, let's talk about the call option. This is assuming that you're buying a call as opposed to writing the call. Writing the call, this payoff diagram would just be pretty much inverted, meaning you would receive value for the call option, and then if the underlying stock price continued to go up, you would then see it slope down, and then vice versa with this put diagram, payoff diagram. It's the same thing. If we're showing the buying of a put option, but again, if you were the writer or creator of the put option, you would see just the opposite in terms of the payout diagram. All right, so back up here to the call option, and let's just look at over here to the right. We've got a strike or a current stock price of $28.75, an exercise price of 30. Number of or the length of time is just 90 days or 0.25 of a year. The variance is 0.04. Riskless rate is 0.036, and then this also includes an annual dividend yield of 3.9%. And when we plug all that in, we see that the value of the call is 64 cents. So again, over here to the payout diagram means that we would, if we purchased the call, we would be down 64 cents, but then at the strike price of $20 or $30, we would see as it goes up, eventually to break even, and as the price underlying value of the stock continues to go up from there, continue to show increasing gains. The put option, if you bought a put option using the same thing, the numbers that we use for the call option, so I won't go through all those, but you end up with a put option of $1.90. So that means that typically with a put, you're buying some level of insurance, which means typically the price of the stock is somewhere over here to the right, and as the price falls, you get the benefit of owning the put option. Now, since we're using the same numbers we used in the call scenario, we were actually already a little bit on the other side of the strike price of $30 a stock. We're assuming it continues to fall with a put, and then as it falls more, you eventually hit the break-even point, and then as it continues to fall, the value of the payoff from owning that put increases from there. Now, at the bottom of the screen here, we're showing the put call parity. And so what we're showing here is the $1.90 that we calculated for the put, the 64 cents that we calculated for the call, and then here's the $28.75, which is the current stock price. Got to do something to include the dividend in this put call formula, and then you can see the rest of it. But anyway, we end up with $1.90, so the put call parity does hold. Shown now is a spreadsheet that can be used to calculate the value of a call and a value of a put. It'd be easy to add into the spreadsheet that I actually got from Dr. Demoterin from New York University. You could add all the indicators that we've talked about, namely delta, gamma, rho, things like that, because we did show the exact formulas to calculate those indicators. But here we have the 6 values that you can enter in, and then down here it shows the call and the put. Now there's lots of sources out there for doing this kind of calculation, including this site here, that you just simply enter in the strike price. It doesn't include dividends, and you can easily do a quick calculation of a Black and Scholes European put and call from this website, and then one from the Options Industry Council. That's a little bit nicer because you can enter in a specific ticker, and it will bring in information directly, and you can specify what an American or European style call or put to be calculated. Or it shows you the call and the put, but then if you can also specify what is the current quoted price, and then it'll show you the implied volatility. So it's pretty nice in that regard. So like I said, spreadsheets, websites, lots of different places to go to get values of puts and calls. As mentioned earlier, it is typical to use the option pricing formula to price, call, and put options, but you can also use the option pricing formula to price other financial assets that have a payout diagram similar to a call or a put. So what we can show next is how to value the equity of a company using a call. And so what you can assume is that the bare minimum value of a company is the value of its debt. That as a distressed company continues to encounter more and more stress and hardship, eventually the bond holders would require liquidation and for repayment of the debt. So the debt of the company becomes an absolute minimum value for the company. Equity is a residual claim, so the overall value of the firm then starts to rise above the value of the debt. The payout to equity owners looks a lot like a call option. So the values you would use in calculating the equity value, you would use the present value of free cash flows to the firm as the value of the firm. The strike price is the face value of the outstanding debt. Now stress here the face value. And then the life, here we're assuming that the debt is limited to be 10 years, or saying that within 10 years that debt would be due, and we would go with the time period of 10 years. The variance of the firm here is we're using 0.16 of the underlying asset value, and then the riskless rate is 10%. You can see here that the underlying values that get calculated are used in the Black and Scholes. So we end up with the value of the call, which is the value of the equity, of 76 million. That means the value of the outstanding debt is the current value of the firm at 100 million minus now the value of the equity, which is right around 76 million. So the current value of the debt is 24 million, and the equity is right around 76 million. Now, using a call option to value equity in a firm is best used for a distressed company that has a fair amount of debt, that has a true enforceable contingent claim against the assets of the company. Well, another use of as options is to value projects within a company, and here what we're looking at is two different projects. One project, we call it the expand project, and the other one is kind of referred to as the abandon project. Up here first, the expand project, the payout diagram looks similar to a call option, and what we use for the underlying asset is the present value of the project under review. So let's review what we're doing here. So we're asking the question, what is the value of owning the rights to televise the Olympics in 2 years? So it's a future event. We'd like to get an idea of what we could sell that right for, or what it's worth to us. We know that it'll eventually cost $40 million to do for the production costs to televise. And we expect currently, that the revenue that will be generated will be $30 million. But there's a lot of uncertainty around that, so there's a standard deviation of 0.30. And then we're assuming a riskless rate of 5%. So the present value of the asset today is $30 million. We know it'll cost us $40 million. So it is saying, okay, if we start the project, or if we do the project, we're in for $40 million. And then once we start the project, we're assuming that we'll be making $30 million, but there is quite a bit of variance in that. The time frame is 2 years. The right here that we have before we start is 2 years. Variance we've already stated, the riskless rate, and then there is no dividend. And so now we see that the value of the call in this scenario is right around $3 million. So owning this right, we could legitimately claim that it's worth $3 million for what we face going forward. Another type of project is an abandoned project, or you want to reverse a decision that was made. So let's look through the scenario. What is the worth to have a cash out option of $400 million over the next 5 years of a 30-year project? This could be something like maybe you're doing some kind of a joint venture, and the company's offered as added incentive that provide you a way to allow them to cash you out within the first 5 years if you so desire. Initial investment you have to make is $500 million, and the present value of your future cash flows is $480. So you can see here that if the initial investment is $500 million, and you know that expected cash flows is $480, that your the net present value is minus $20 million. So typically it would not be a project that you'd want to consider. But with a cash out option of $400 million, it needs to be reconsidered. So the expected cash flows to be distributed annually over 30 years is essentially through the dividend. I'll leave it up to the viewer to possibly stop the video at this point and look through the details of how this scenario was set up in terms of a put option. But what this project of abandoning really demonstrates clearly is how important it is to frame, in other words, map in the scenario into the option, and then the values you use for the different values of the option. So up here also use the concept of framing as a call option, and then what the values would be. And to secure that a little bit further, now I'm going to show the project that deals with delaying a project. And the question that's asked is, what is the value of delaying the commercialization of a drug that has a 17-year patent? And delaying is in the hopes of an improving business environment. And then what we're assuming here is that we have an initial cost to develop a drug, and we're going to have a patent on that drug for 17 years. And I won't go through all the details. I just wanted to show you again that this kind of thing can be framed in the context of a call option, and then you end up with some value of this opportunity of around $907 million. All right, next going to talk about different combinations of calls and puts, namely callers, straddles, strangles, and spreads. The upper right-hand corner here shows the payout diagram for a caller. And a caller is a strategy that limits both gains and losses. It's created by holding the underlying stock and then buying an out-of-the-money put and selling an out-of-the-money call. So typically what this is used for is if investor feels that there's a good chance of a downside potential in the market or in the particular stock. Starts off with buying a put to cover any substantial losses, but to compensate for the cost of the put, we'll also write a call to generate proceeds to offset some of the cost of the put. Now, the trade-off of doing that is it also gives up extreme gains on the upside. But again, if the investor has an opinion that the market's more likely to be falling, this strategy is appropriate. Upper left-hand corner, here's it's known as a straddle. It's primarily just a call and a put being purchased at the same exercise price. This is assuming someone believes that there's going to be a fairly significant move one way or the other, just doesn't know which direction. If the stock goes down, you get a good payoff. If it goes up substantially, you also get a good payoff. Interesting, if you do this the opposite and invert this, then you're looking at something that you're anticipating not to move much at all, and you're trying to optimize or get the most by little movement. Down here you have what's called a long strangle. It's very similar to a straddle, but you can just see here that instead of being a single point, it flattens out here in the middle and then gets more upside on the extremes. And then the opposite, or the mirror image of this, would be just the opposite, where you're thinking that there's more chance of some movement, but not a lot of movement, so you're trying to benefit from just some movement in the price. And then over here to the right are some more interesting ones, namely what's called a butterfly spread. Now at the top here I do talk about what, in broad terms, what a spread is defined to be, and it's just simply when you're buying multiple options and where the options differ in either terms of expiration or exercise price. If you vary the exercise price, they're called vertical spreads. Change the expiration dates, is known as horizontal. The terms vertical and horizontal have to do with the way options are typically quoted, namely in a grid form called a options chain, where the different exercise prices are listed vertically and the different expiration dates are listed left to right or horizontally. Now you notice this butterfly spread involves four different options, 2 puts and 2 calls, and you're buying them either in the money or out of the money, and lets you kind of think that through of how you end up with this payout diagram. It's similar to the mirror image of the straddle that we talked about right off the bat. It's just that instead of having downside be infinite, it caps it off, resulting in a bit higher price for the overall position of the options. This obviously would be used if you felt like there was going to be very limited move. In case there were larger moves, you want to economically limit your losses. Last one shown is a iron Condor Spread, and it's similar to the butterfly spread. It's just somewhat like the reverse strangle. Just broaden things out in the middle so that you can benefit from a wider range of variation, small variations, and then cap your losses if you were to have extreme movements. It should be noted that some of these are so popular that when you put on your tool that you're using, but most tools that allow you to buy and sell and track option purchases will have built into them collars, straddles, and strangles, and spreads, and iron condors, and so it'll automatically keep track of your position, and so you don't have to yourself keep track of these individual options and then piece it together in a spreadsheet or something to see what the net position is. Good option tools will do that, have that built into them. All right, well, that wraps things up. There was a recap. We talked about the derivation of the Black and Scholes option pricing theorem, the application of it in terms of valuing calls and puts, and even equity of firms and projects. And then we ended the video here talking about different combinations of calls and puts. Things like collars, straddles, and strangles, and butterfly spreads, and iron condors. So in closing, I just want to leave you with the same slide that we started out with. I want to stress that with financial options that there is it's called the intrinsic value, which is just the difference between the current stock price and the exercise price. That if you're in the money, the stock price is above the exercise price if you're talking about a call, and if it's a put, it means that the current stock price is below the stock or the strike price. Well, that's the intrinsic value, but there's also this time value that this graph is showing. When there's still time left in the option, the variability of the underlying stock results in there being value in just the fact that there's time, because there is potential for the underlying stock with time left on the option to still move around, and that means there's an opportunity for it to move even higher, and therefore the time remaining on the option has value. Now, I need to keep in mind the importance of volatility as it relates to options. So we go back and review the inputs into the option pricing model. The stock price, that's out there, available. The strike price, that's built into the contract, so that's available. The risk-free rate is something that easily can be looked up. Time is set by the contract, and then the dividend yield is a number that's easily looked up. So it's really the main value that has to be determined by the investor is the level of volatility that they're going to assume. So it's important to look at what the markets, what the current price for a put or a call is, and what the implied volatility built into the price. Think about your own volatility assessment. Remember that historical volatility is at best a kind of a crude proxy for future volatility. So with so much of option pricing be based on future anticipated volatility, it makes pricing options very challenging. It's important to look at the Vega term, which is the rate of change of option value with respect to volatility, and how the investor's volatility assessment relates to the implied volatility built into the option price. So my last comment is that, back to this volatility, that really options is a trading tool that moves the decision from pure pricing to volatility. And if you want to try to take advantage of better insights into not pricing but time-bound volatility, otherwise known as risk, then options is a reasonable tool. All right, hope you got something out of this video. Thanks for watching.